Okay, ladies and gentlemen, can we take our seats, please? So welcome back to this, our third panel, this on coping with uncertainty and risk. We are blessed today with panel members who have spent their careers identifying, measuring, analyzing, and grappling with risk and uncertainties. I think Professors Harris and Easton were skilled in picking panel members who illustrate how to cope with risks successfully. They also made an interesting choice for panel moderator to show you the consequences of failing to manage risk successfully. Each of our panelists have distinguished backgrounds. I will not repeat them. They're available, of course, in your programs. But I would like to observe that not only are their current roles relevant to this discussion, but also their previous roles are relevant too. All in, this panel has background in a wide range of business activities, and let me give you a partial list, divided between disciplines and industries. On the discipline side, academe, financial analyst, antitrust, arbitration, auditing, consulting, corporate governance, intellectual property, law, both commercial, securities, and trial, senior management, and standard setting. On the industry side, consulting, financial institutions, industrial companies, legal, media, not-for-profits, pharma, public accounting, tech, and telecom. So it's clear that we have an extraordinary breadth of experience from the panel. And it's also clear that we suffer from attention job disorder, for which two of us are in therapy. We'll follow our panel process as we did this morning. Each of our panelists will offer 10 to 15 minutes of prepared remarks, and then we'll go to Q&A. Tom?
Greg. I'm waiting for this. Oh, they're up. Okay, good. Well, I found it very interesting to think about coping with uncertainty and risk from the standard setting perspective in financial reporting. Greg started by saying that the panelists all have expertise in doing this well. In reflecting about coping with risk and uncertainty in financial reporting, I don't think I'd make that claim. But what I'm going to want to do for you today is sort of talk through where I think the different ways financial reporting has attempted badly in many instances to try to reflect risk and uncertainty. But before I start, and apologies to Trevor Annette and Mr. Knight, I think of risk and uncertainty in a different way. And it's helpful, I think, maybe in a financial reporting perspective to think about it as follows. I think of uncertainty as being represented by the shape of a distribution of possible outcomes. That is, it's an attribute of the economic phenomena. Now, you could be uncertain about the uncertainty. You might not have a complete distribution, but it is about the shape of the distribution. So uncertainty is represented by variability in potential outcomes and differences in their likelihood of occurrence, from at least the perspective I'm going to share with you in thinking about reporting in this area. In contrast, for me, risk represents the compensation demanded by individuals, entities, market participants for taking on uncertainty. It's an attribute of the market participant or the individual. I'm thinking about risk aversion, risk seeking as an attribute of the individual. Risk averse market participants seek compensation for downside variability in the distribution of uncertain outcomes. I asked myself the following questions in putting this together. Should financial reports reflect both uncertainty and risk? And if yes, how and can it be done well? So let's think about some of the things financial reporting has done related to uncertainty first. There's several different ways uncertainty has been reflected in financial reports or not reflected. One is through the recognition thresholds, where recognition thresholds limit recognition in the financial statements of an asset or liability to those that are either probable, reasonably possible, more likely than not. This addresses uncertainty by not recognizing in financial reports the uncertainty for assets and liabilities with lower likelihoods of occurrence. In a sense, it introduces bias against reporting lower probability uncertain amounts that misrepresents the potential effects of the entity outcomes that are uncertain. This issue is exacerbated when you have bimodal distributions or significant nonlinearities that would tell you that 60% of the time the liabilities were zero, but some other lower probability it could be catastrophic for the entity, and we wouldn't recognize it with a threshold. Uncertainty is also reflected through some decisions about measurement in the financial reports by reflecting uncertainty in outcomes in point estimates, by reporting expected values, means, or best estimates. And best estimates may be whatever management pulls out of the air, or it might really mean mode. Okay? Both of these measures provide no indication about the shape of the uncertain distribution, therefore limiting the information provided again about uncertainty in the reports. However, when you think about a mean, it at least incorporates fully all uncertain outcomes in its probability-weighted measure of central tendency. But again, what we'd be doing, even if we did probability-weighted outcomes, it would be about individual transactions or events or accounts. And if we wanted to think about the total uncertainty in the entity and then try to add up those uncertain amounts, that could be misleading if we don't consider issues about diversification and or statistical dependence in that aggregation process in understanding the effects of uncertainty. Uncertainty primarily has been dealt with in financial reports through disclosure, but not consistently nor comprehensively. The boards, in their current deliberations, are often discussing things like measurement uncertainty analyses, which reflects uncertainty in the recognized measure today by disclosing potential ranges in reported amounts if different feasible inputs or different measurements were used about that item. So it's uncertainty about the measurement at today's date. In addition, there is some reporting that looks at forward-looking measures of risks and opportunities that reflects potential uncertainty in the future asset or liability due to outcomes differing from those expected. Some of those in the 10K reports deal with things like value at risk or sensitivity analyses related to underlying changes in rates or prices, but note, you can only do that if you understand and know the knowable uncertainties. Because if you don't know the normal behavior or where the uncertainty might morph to, you cannot predict well or give a number about what that uncertainty might cause changes in rate assets or liabilities in some time in the future. There's challenges in the usefulness of these measures again too. They're very difficult to aggregate those amounts meaningfully at the entity level. And I think what's really important is if we're going to portray uncertainty or risk, it has to be at the entity level, or it's not going to be very meaningful. And again, that's going to be challenged by diversification challenges and statistical dependence. In particular, if we think about things like value at risk, you got a real big problem as to its meaningfulness if what the measure is based on management's views of certain inputs in the model, because management's going to have different views and different methods than their competitors, and it makes it very difficult to compare, therefore, the value at risk amounts across entities, and therefore hindering potentially the meaningfulness of that reported number. Value at risk is a very good measure in that it actually considers statistical dependence in the calculation, but it's not very meaningful because it says the entity could lose X dollars 5% of the time, and you don't have any understanding in that reporting as to what direction the rate or price would change to cause that loss. So the ways people have dealt with that is with sensitivity analyses. But the problem with sensitivity analyses is it doesn't capture statistical dependence well, and so it is just a guess at what might the asset or liability direction might move, or the overall risk might move in the entity based on not real economic circumstances. So again, what is the meaningfulness of that number? So disclosures can be very challenging. What would investors do with that information? Sometimes I don't understand exactly what that would be. I think Trevor asked me that way back after the SEC market risk disclosure release came out, and I went and talked to Morgan Stanley. What do investors do with the information? That's going to be a challenge. There's also, we've dealt with uncertainty and risk. Now note, everything I've talked about so far is uncertainty about the distribution of potential outcomes. We don't often introduce, at this point, anything about risk that is an individual or market participant's compensation or view about that uncertainty. But we can deal with uncertainty through the selection of measurement attributes too. One being fair value, where fair value measurements reflect on a timely basis change in market participants' views about the expected value of uncertain outcomes and incorporate risk by ending up, if you think about it in a level 3 measure for an income-based model, you end up discounting those cash flows by a risk factor. And it happens to be the challenge is to think about market's estimate of that risk discount. Much of the controversy about fair values is not that we might find the uncertainty in the cash flows useful. The question really becomes is whether or not that market rate discount is useful to understanding the entity well if they're not going to exchange that particular asset or liability. In contrast, though, we also have remeasurements within a historical cost model, remeasuring expected cash flows and lease payments. That reflects uncertainty on a timely basis based on management's estimates of changes in the uncertain costs. So difference between fair value and historical cost is, would you rather have market participants' views of that uncertainty or management's views about that uncertainty? You will also almost always have risk in those measures, because if cash flows are over time, you're going to discount those cash flows. But in the accounting model, we've been woefully bad at thinking about linking that discount rate in a historical cost model to the uncertainty in the cash flows. Why would you ever discount a liability at an asset rate? What is the risk in the asset rate? It's a risk compensating for uncertainty in the return in the asset. What does that have to do with the liability? We've not consistently thought about that issue remotely over time. And the boards are being challenged to do that very strongly by the insurance industry now. Finally, you might think that in the accounting model we think about uncertainty or risk related to hedge accounting. So you could do it through hedge accounting by changing the accounting for the derivative or the hedged item so that the effects of changes in the underlying rates or prices on the derivative in the hedged item hit income in the same time period. However, hedge accounting only reflects the effects on income of uncertainty the uncertainty being managed by the company. It doesn't tell us anything about the uncertainty that's not being managed. And so what usefulness is that? Especially if what you think about, and what Annette had said earlier, is that she described risk, and I think what Trevor did is uncertainty that you know enough about that you can manage it. You can measure it and you can manage it. Think about derivatives. You can only have a cost-effective derivative for risks that are well understood, because then you can determine a price, and that price will not be very expensive. For risks not understood well, you can't get a price, or if it's really risky, the price is too expensive. So what ends up happening in the accounting model with hedging is you end up showing the outcome effects of maybe not the most important risks. Yet the user of the financial statements might actually have the view that hedge accounting tells you the risks that are most important to the entity because they're the ones that are being managed. and it may take the eye off the ball as to really where the most uncertainty and risks are in the model. And certainly, at least, we ought to think about measuring all of the risks in a hedge accounting model, not those just managed in the hedged item. So in thinking about it, I didn't find a lot of positive ways in which the financial reporting model does a good job with uncertainty and risks. But policymakers should consider on a more consistent basis whether financial reporting reflects the effects of uncertainty and uncertainty for sure. And it's an open question about risk for me. It's the issue about whether or not, if you're not going to trade the instrument, you want the risk premium. But at least we should think about uncertainty, and at minimum, we shouldn't do it badly. We shouldn't misinform. And my conclusion in thinking about some of these ways of doing things is that we're misinforming about uncertainty and risk in the financial reporting model. We're not helping, we're hurting. So the challenges of doing it well are immense, but it's been fun to think about it for the conference and challenge myself to do it better at the board table.
Tom, thank you. John?
Okay, thanks, Greg. I'm John Veihmeyer, the Chairman and CEO of KPMG, and what Greg really asked me to focus on for a few minutes here in these opening comments really relates to how, as CEO of a major professional services firm, how do we think about managing risk and uncertainty in our own business, if you will, particularly as you add the dimension of being part of a global network of firms under the KPMG umbrella, and the added risks and dimensions that brings into the equation. So I'll spend a few minutes on that, and then obviously in the Q&A we can get into whatever other issues may be on your mind. But as you know, I think about in my role as CEO, how do we look at risk in our business? We have a pretty robust enterprise risk process in the firm. We've been using it for about 5 or 6 years now, and it looks at risk across a number of dimensions. It looks at operating or operational type of risks, legal risks, regulatory risk, brand risk, global risk, because I think that there's a whole separate category of risk and uncertainties that come in by virtue of operating on a multinational basis. But what I thought I'd focus on in particular here with a couple of my opening comments are the risks associated with what we characterize as our professional risk, our professional practice risk, as we go into the marketplace and provide the market with the professional services that we deliver. So I think as you focus on professional risk to a firm like KPMG, it all starts with who are we working with? Who are our clients, and who do we want to work with going forward? So, you know, we've built some pretty robust processes around those dimensions of our risk profile that we think are most important. And if the risk of associating with someone that is going to incrementally increase the risk to our firm in a way that far outweighs the benefit of whatever fees or other value we derive from that relationship, then we want to catch that before we get into that relationship. So we invest a lot of time and effort into evaluating who are those clients that we want to work with. And that takes a couple of dimensions. It's what business are they in? And over the years, we have certainly evaluated certain sectors as ones that we aren't real interested in aligning with. And they vary over time, maybe as you would suspect. You know, there was a period there where we had decided subprime lenders were an area that we did not want to be associated with to any significant degree from a client-based standpoint. Unfortunately, by the time the subprime bubble broke, what had happened in the industry is, as opposed to a number of discrete entities which we had largely exited from a client-based standpoint that were doing subprime lending, you were finding that subprime lending was being done by the largest financial institutions out there, many of whom were and are our clients. So I guess it points to, notwithstanding a conscious decision about 8 years ago, 9 years ago, long before I think the crisis that we've all seen over the last few years, a recognition on our part that subprime may add significant risk to our client portfolio. It crept back into our portfolio through organizations that were diversified but had an element of subprime. So that's just one example, I think, of evaluating industry risks that may affect how you select what clients you want to work with. The other aspect or dimension is obviously the individuals leading organizations. So how do we control or manage that risk? We do background checks on the primary officers of any company that we are considering taking on as an audit client. And I will tell you, we have absolutely, I get questions sometimes, does that ever matter? We have absolutely walked away from doing business with certain clients and declined the opportunity to serve as the auditor for an organization because of something that came out of the background checking process on one of the officers of that company. Those are always delicate conversations with the board once you find something about their CEO that they may not have been aware of. So certainly as we look at professional risk, again, it starts with who are we working with, and we pay a lot of attention to that. I think then you move to our people's compliance with the processes and procedures that we've put in place. We feel like we have a pretty well-developed risk management architecture from a professional practice standpoint, and we view as one of our significant risks the risk that in a firm of 22,000 people in the U.S. and 140,000 people across the world, somebody may not get the message, and somebody may not read that risk management manual the same way we intended it, or may decide for any number of reasons that they're going to execute differently than if one of us was sitting there at their elbow, we might want them to. So a tremendous amount of investment in the form of both training and then compliance programs to try and make sure that we do two things. Number one, we send a pretty strong tone from the top of the firm to all of our people that there is one thing we won't compromise on, and that's the quality of the work we do. So there are no shortcuts around the processes and procedures we've put in place. So the tone is important, but then secondly, a pretty active quality monitoring process, if you will, of checking the work done by our professionals, both in the U.S. and outside the U.S., to make sure that, in fact, they are adhering to the standards that we assume and we hope they are. Back to the one comment on the tone at the top issues. I think one learning that I've certainly come to over the last 5 or 6 years since I've been in a national leadership role, and for about the last 6 months I've been the chairman. For the 5 years before that I was a deputy chairman of the firm, and I'm going to oversimplify this, but I probably naively came into that deputy chairman role 5 or 6 years ago thinking that, you know what, if I get on a conference call with all my people once a quarter and I send some memos on a pretty regular basis, that everybody gets it. All 22,000 people will understand what's important to me, what kind of culture we're trying to drive, and I can rest easy. And the reality is that's not the way it works. And we have spent a lot of time over the last several years developing what we call touch points. And it's really a recognition that while hopefully our people listen to some things that, as the chairman, I say, although that's probably a pretty small percentage of what actually gets through to our people, what they really do pay attention to are the people they're working with on a daily basis. The people closest to the action of what they're doing as they serve clients are the people that have by far the most influence on how our people conduct themselves. So if we really wanted to make sure that we had a culture at KPMG around high quality and ethics and integrity, we need to really do some work on how do we cascade that through every dimension of our partner and employee base. And we developed this program we call Touch Points, where we really went through a process of what is every interaction we have with our people, and then reassess how in that interaction we're conveying the type of ethical culture that we want to drive at the firm. So it starts with recruiting, it then moves to training, and every other formal interaction that we have with our people, and we've totally redesigned the types of messaging, the types of things we're communicating about the firm at every one of those touch points. And then we got disciples and people that were specifically charged in each of our practices, in each of our operating offices, with trying to make sure that they were reaching all of those touch points with our people, and we aren't reliant on memos or webcasts from senior leadership as the sole mechanism of trying to influence the behavior of our people. On the monitoring issue, that is obviously complicated when you think about the international dimension of what we do. As we're serving a client, multinational based here in the U.S., to conduct that audit, we involve a lot more people than just folks here in the U.S. And as an engagement partner, as an example, who's signing General Electric's financial statements, you are very much reliant on about 80 other member firms around the KPMG network, and making sure that they have the same focus, emphasis, and rigor around quality as our offices in St. Louis and New York and San Francisco might, as you're relying on them. That requires that we build a very extensive network of that we refer to as our global risk management network, to do all of the things I just talked about here in the U.S., but then figure out how we make it work on a global scale. So it's a very active program of sending teams from outside member firms into those countries to make sure that as a firm we're seeing the right kinds of things around emphasis on the right training, messaging, around tone at the top, so some organizational and institutional level things, and then a separate program where we go in and inspect individual engagements being conducted in those member firms to try and make sure that we are seeing the same approach to the same issues and trying to drive as much global consistency as we can. This is a never-ending, I think, challenge. It's a never-ending journey, and it's one that we need to pay a lot of attention to on an ongoing basis to make sure that we continue to do everything we can to get it right. So I would say integral to managing this risk is to have a very active and disciplined monitoring program of helping our people learn through the rigor of a quality checking mechanism that identifies situations where they may not have conducted a particular engagement or provided a particular service in the way that we would have wanted them to. One of the other elements that I think is critical, in fact, it may be one of the most critical to managing professional risk, certainly in KPMG, and I think in most organizations, is making sure that compensation structures are aligned with the behaviors that we want to see. And I can absolutely look back. I won't point fingers elsewhere. I'll point fingers internally. There was a period in KPMG's history when I think our compensation program, when you go back to the late 90s, was probably not aligned with, at least from my perspective, the types of things we do want to be driving from the top. So one of the first things that my chairman and I did 6 years ago when we were elected was to eliminate incentive compensation in the firm and completely transformed our compensation strategy to a structure where every partner is told at the beginning of the year what their share of the firm's profits are going to be, assuming that we hit plan for that year. And if we exceed or fall short of that plan, then every partner goes up or down the same pro rata share. And we did that over, I think, tremendous opposition for one reason, that we wanted our partners to feel like they were with one firm and how everybody goes, they will go. And we wanted to eliminate the risk that in a model where individuals could earn 30 or 40% of their total compensation in a year in a variable compensation scheme, that people weren't incentivized to do things which may have some short-term upside for the firm, but when you look at a long-term enhancement of the brand, a long-term value proposition around what we want to be as an organization, you may come away with a very different view. So we want all of our people, our partners, and all our professionals focused on the long-term proposition of how we continue to improve the quality and enhance the value and the brand of KPMG, and not short-term hits. And I wasn't confident that we could design an incentive system that would appropriately reward and recognize that kind of long-term behavior, as opposed to what most incentive programs are very good at doing, which is to incentivize very short-term focused behavior. So we eliminated it. So, and I still feel very strongly about that, so it's hard for me to have a discussion about how we manage risk without also talking about how we reward and recognize our people, because I think if you don't get those two aligned properly, it doesn't matter what I message, it doesn't matter what other programs we put in place. I think we'll get consequences that I won't be happy with at the end of the day. So I can't overemphasize, I think, the importance of that. Maybe the last thing I'll touch on here very briefly is just I don't think this is a destination. I think managing risk, particularly professional risks in a professional services firm, is something that you always have to lay awake with one eye open all the time with respect to. Having said that, I think we also have to guard against an environment or a culture where you think you can reduce risk, as opposed to the way I think we try and think about it, which is you are mitigating risk. It would be very easy for us to eliminate risk. We just wouldn't take any new clients. That may not be real good for the future growth and development of our people or any other dimension. So this is a real balancing act, I think, of trying to make sure that people are aligned in terms of having clarity about the objective of what we are trying to be as an organization, what we're trying to achieve, put the incentives in place that will encourage that kind of behavior, but recognize that we are not trying to eliminate risk. We're trying to manage it to an appropriate level. And that is a very delicate balance, because you can swing too far either direction, I think, on that teeter-totter. And that's why I think it takes the active involvement of senior leadership to get it right. So my vice chair of risk in KPMG reports directly to me. I think one of the things that at various times in our structure has been a drawback is the person charged with ultimate accountability and responsibility for our risk management program has reported too far down in the organization. So I've elevated that, and in my team of 8 people that report directly to me, one of them is my partner in charge of our risk management processes and programs. So let me just stop there. I think those are the main comments, Greg, that I would tee up initially in terms of how we think about risk, and happy to get into any other issues when we get into the Q&A that you all would like to discuss.
Terrific. John, thank you so much. Betsy?
Okay, great. Thanks, everybody. I'm Betsy Graseck. I'm with Morgan Stanley. I am a bank analyst. I've been a bank analyst for a couple decades and have focused on banking in both the U.S. and Japan, and then I spent a brief amount of time between 98 and 02 as Associate Director of Research for Tech, Telecom, and Media. So I had a little bit of a run through that bubble and bust as well. So as a user of financial statements, I want to thank Trevor for inviting me to present. About a year ago, when I thought about how busy I was and was I going to be able to make it or not, and I committed to you a year ago, and I really appreciate the opportunity to be a sole user in a room full of accounting experts. So, bad news for me is I can't speak during the prepared remarks long enough to eliminate the Q&A session. So I will allow some of the more fun discussions maybe to happen then. But I guess what I would say, just as an overview for how I think about uncertainty and risk in looking at the balance sheets of the institutions, the income statements of the institutions that I'm tasked with understanding, I guess I'd first kick off and say, I know that I'm never going to get it 100% right. I know that we're never going to get 100% certainty. And in fact, when I talk to new folks in the investor community who are focusing on banks and picking up banks for the first time, I welcome them to the world of assessing the value of an equity tranche that is in a blind pool of risk. Right? I think we all have to understand that for the financial statements of the banks, we are never going to get 100%. Right? So it's always about trying to assess where are those tails? Where are those tails going to hit us next? Are they being reflected in the statements or not? I really do view the financial statements as a starting point. And I'm always asking myself the question, again, is it representative of the business that exists today? Is it representing the kind of new risks that are going on in the marketplace? How historical is it? What type of things can I use to assess a forward look based on what's happening in the marketplace? And like I mentioned, you're never going to have 100% certainty. I do spend time on the accounts. Hopefully that's a good insight from a bank analyst. My associates probably spend much more time, and when I was starting out, I spent almost 95% of my time on it, but I would say at this stage, probably we're talking about 15 to 20%. Where I'm spending a lot of my time is thinking about the inputs to the business models of the companies that I'm focusing on. Where are the inputs changing? How much are they changing? And then going to those management teams going to, there's not much of a supply chain, but you can think about, kind of supply chain around the banks I cover. What are those companies seeing and hearing and thinking with regard to the risks in their businesses? Let me give you an example. Let's talk about the blind pool of risk called the FIC business. That's also known as the bond trading revenues that many of the big banks that I cover have. So in the financial, within trading, you have equity trading, you have bond trading, and FIC is essentially fixed income, commodity, and currencies. You get one number. You also get a couple of different data points. We can look at VAR to a certain extent. We can see some things in the notes. But really where we are able to assess whether or not there's going to be something that we need to focus our time on is what's happening in the marketplace. Are you seeing volatility spike? Are you seeing trading volumes collapse? What's going on with the regulations? Is it going to take out end users such that your forward look is going to change dramatically? And then we, with that, go back and talk with management teams and basically give them our sense of what we think the numbers end up being. And sometimes it works and we get a little more information, and sometimes it doesn't, and we go back and craft our debate and argument again to come up with a response at the end of the day that helps us understand if we're moving in the right direction or not. I know that sounds very squishy, but that's how it works. And when you think about the investors out there, obviously on the sell side, the buy side is doing the same thing, and frankly, in some cases, a little more rapidly and a little less, with a little bit less certainty. But again, a little bit more rapidly. On the buy side, he who gets the right answer first wins. So they are looking almost entirely at the inputs and trying to assess whether or not the street has it right. Estimates are going to go either up or down, and is it reflected in the stock prices yet? Yes or no? I'll touch on briefly on what I would like to see in financial statements. And I was lucky enough to be on the FASB user board for several years, and I did, at Bob Herr's request, give a presentation to the board members. Was way back when, I don't know if it was 04 or 05, something around that time frame, right? Do I want fair market value? Do I want cost? What do I really want? And ultimately, I said, either way, you always have some pros and cons. There's never one perfect answer. My assessment was what I really wanted was more information. So to Tom's point earlier, it's about assessing those tails. And as an example, we look at loan books. We would like some very basic information, like what's the roll rate of a loan book, so what's your new loans and what are you writing off and what are you refinancing and what are your clients paying down? I mean, those are pretty basic stuff. But in addition to that, you'd like to know what is the credit quality of that loan book by major asset classes, call it secured, unsecured, consumer, and corporate. Each of those is about 25% of the loan books of a bank. So you'd like to know what that credit level is. You'd like to know what the tails are. So within each of those asset classes, what's your 10% tail risk? If your average is, let's call it a consumer credit card, and you have a 750 FICO, I say that's nice, but it doesn't tell me anything, right? Your average is meaningless. So, what is your skew between 500 and 850? Is your skew, 450 and 925? I mean, it makes a difference. That's what really matters. And what are you earning on that, right? Is your 10% tail earning you enough to cover your risk? I might be okay. As an investor, I'm okay with that. And then how is that going over time? What is my new loan coming in at? Is it above or below my existing portfolios? Vintage curve analysis, really basic stuff that the bond market spends a lot of time thinking about. We don't get in banks. And look, there are parts of the cycle where it would hurt them and parts of the cycle where it would help them, and they give it to you when they want to. But we'd love to see it all the time. I know it's easy for me to ask. It's hard to deliver, and no one wants to agree. But as a user, I guess what I'm really saying is I want the information to be able to assess how the portfolios are trending. Is the risk increasing or decreasing? Are you being paid for the risk or not? And in a recent meeting that I had with some folks from FASB and ISB, we went through reserving, and I won't get into that. I could share that with you afterwards, my thoughts on reserve accounting. But we also talked a little bit about derivatives gross up, which I'm not a fan of for a variety of reasons, but we get it in the footnotes anyway, so I don't know why we have to go through this. And by the way, the more we keep on doing this, you're just gonna push people out of the business. Okay, we've almost had it, but that's my own opinion. I don't know. I mean, QRM. That was something else that came up the other day. I just couldn't believe how far regulators were pushing on that one. But my point is, one of the other things that we discussed at that meeting was all this information, and I just went crazy and sang a celebration song. That's really what I think the user group is looking for. And it's already started, as you well know. We do have some information on the loan books that has come out recently. It's Bob was asking me, how did we like it? Hey, it's great. It's going to be something that, in particular, over time will help. And I think there's this question of, well, what about the comparability? And I get this from investors when this came out. And I said, okay, look, maybe it's not comparable institution to institution, but we get so hung up on it has to be comparable that then you're going the lowest common denominator of information that you present. So I'm okay with the fact that there's a little bit of nuance, different banks, different definitions of what that risk portfolio is, but it is a great starting point to getting more information. And hopefully I gave you a little bit of a color for how a user thinks about the accounts.
Thanks very much. So I'm a commercial litigator at Greenberg, Traurig, and one doesn't usually like to talk about their cases as being big cases or in the news a lot. I was actually hoping Greg was going to say that. But by the time it gets to me, something has gone seriously wrong. So somebody has already made a risk assessment failure, and you wind up sitting around when you do my job saying, what in the world were these people thinking? And you're talking about large companies, you're talking about people who would be described as or describe themselves as the smartest people in the room, and they usually aren't, because they usually forget, right? They usually forget big things. A lot of the detail that people have been talking about is great in a static environment. There's a lot of, the author of The Flaw of Averages is in the room, and there's so much great knowledge that you intuitively know that people will tell you is wrong because it doesn't fit a model of some sort. So in thinking about some of the remarks to make today, I asked and was told that the characters that make up the Chinese word for risk are wind and danger. So danger and the wind seemed a pretty appropriate way to describe it. It's as good as anything I've ever heard. It's probably superior to Frank Knight's. If anybody would read that book from 1921 and can figure it out, come tell me, because I could learn something. But when you think about wind and danger, and it reminded me, of big things that go wrong. So if anybody has driven down 6th Avenue and you see some of the buildings that have those beautiful water globes in front of them, those structures, and they're so great to look at, and you can imagine all the effort that went into putting that together, getting everything just the right way, figuring out all the risks associated with the water. And it's wonderful to sit around on a day that's not windy, but what happens when the wind blows? People are drenched and they don't sit around it. So you spend all of this time and you forgot about the wind. And these are the kinds of things, at least when things go really, really badly, they're big things. John was talking about the maintenance that KPMG does, and they do a fantastic job of it, of ensuring quality across an enormous platform. And every large professional services firm strives to do that. But what you're talking about there is really the risk of somebody not doing their job well. And I will tell you that the way that people get into mistakes most of the time has nothing to do with policies and procedures. What it has to do with are people, because people are the ones that violate policies and procedures. And I'm not saying that we don't need them. From a compliance point of view, policies and procedures are fantastic, and I applaud them, and where would a lawyer be if not for policies, procedures, and the people who violate them? But, but I will tell you, from the point of view of risk, it's not really the lack of a policy. You don't need an insider trading policy because of any. I mean, you need one to don't revoke your policy, but it's not the people who are honest who are going to give you trouble on an insider trading policy. And as a person who's already set out to commit insider trading, going to be deterred by John's email saying you cannot trade in the stock of this company. And if you take a look at the news, you'll see the latest insider trading scandal involves 3 great law firms. I used to work at one of them, and that they know very well what the policies and procedures and laws are, and it's just not going to deter bad people. So you can do background checks, and you should, and you can do many, many things, but just remember that at least as it comes to people, at least as it comes to risk, at least as it comes to big things that go wrong when bad people act, the one thing I can tell you, it is usually people in silos. It's kind of hard on a big team for somebody to really commit an outrageous fraud. So it's either usually the entire team, and everybody, not to mention Enron, but why not? You're talking about big teams involved in things, or you're talking about silos. So one thing to think about risky behavior in your business may well be moving people around or having some procedure to find out who's working just by themselves. So that's something that I think is really important. When you talk about risk and you talk about trying to find it, implied in that is that you can somehow measure risk. And I think that that's a really dodgy issue, because I think in static environments it's pretty easy, and some of that are all self-fulfilling prophecies to a certain extent. But your model is only as good as the assumptions in your model. So in talking about the subprime issue, for example, there are a lot of smart people in a lot of large financial institutions who had models. And kind of like my example with the wind, they were doing thousands and thousands of Monte Carlo simulations, except not one of them had a real estate decline factored in. That's kind of an important factor to miss. And it is, in fact, the single factor that drives every other part that goes into that model, because you can talk about FICO scores, but FICO scores are not predictive of anything in a massively declining real estate market, because everybody is defaulting at historic rates. It's the price of the real estate decline, and the price of policy that you have to think about when you think about risk, and the law of unintended consequences, which is always our friend when we think about risk. Just to follow in on the subprime issues, you had government policy that said that we want more people to own homes. It's a little tough when those people don't qualify for the mortgages of the day. It's a little bit, wanting more people to own homes, a little bit like saying we want more people to be 6 feet tall next month, because unless you measure them differently, that's not what's going to happen. And so that's exactly what happens in the mortgage industry, is you came up with different kinds of product that allowed people to own homes, and that sounds like a fantastic thing, and it is a great thing. I'm for home ownership, just in case anybody was wondering. But the fact of the matter is that those people are less qualified, and everybody knew it. There was no question about disclosure. The only thing was that people measured the risk wrong because they didn't factor in the primary factor, which was declining rates. So these are all the kinds of issues that, as you think about risk, well, I think it's excellent to have a lot of modeling, a lot of thought, a lot of structure, a lot of detail around it. Don't forget to step out of that and say to yourself in your business, say to yourself in whatever you're doing, what are we doing well? What are the main contributing factors to what we do well? And what would happen if our single most important asset went away? And then see how your model would work. And I think until you do that, until you really deconstruct your risk analysis, not from the textbook example, but deconstruct it from real life. I think until you do that, I think it's very, very difficult to expect to have a risk management policy or procedure that's going to stand up when something really bad happens. Risk it's not too difficult to deal with when everything is fine. If you have a 2-foot tsunami in Japan, you have dealt with that. But one of the tragic aspects of that, among all of the tragic aspects of that, is the fact that they went back 100 years and modeled tsunamis for 100 years. But because that part of the world so frequently experiences it, there's so much real recorded data back very far. And you could go back 1,000 years and know that you would have a tsunami that was just as devastating as the one that hit recently. And geologically, we all know that those are the same things. 1,000 years doesn't matter. And yet they didn't build it to deal with that risk. And it's because it was inconvenient. The other thing about risk, and these are character issues, these are policy issues, these are things that really go to the heart of your business. How much risk you want to deal with is a cultural issue, and it's an issue of character, because a lot of times it's just too hard. And when you say to yourself in a litigation, for example, what were these people thinking? A lot of the time it was just too hard. And it's not a very good excuse in hindsight. So if your job is to model risk, you have a very hard job, because you've got to go to someone like John or someone running a business and say, you've got to do something very difficult. You've got to change what we're doing. You've got to do your business in a more expensive way or a more careful way. And a lot of times people don't really want to hear that. You don't want to hear it in an economy that's as competitive as this one. You don't want to hear it in a startup business because money is tight. But these are fundamental issues. And the ultimate result of getting risk wrong is there are financial consequences, there are moral consequences, and by the time you get to somebody like me, there are significant legal consequences. And in hindsight, it's almost 100% of the time, I've never had anybody say, boy, I would just do the same thing over again, no problem. Of course, you would change what was going on. And there are real head scratchers out there when you look at what people wound up doing and you sit and say, that just makes no sense. But you're in the moment in time. Remember, you're all in the moment in time when people are actually engaging in that head-scratching behavior and nobody's noticing. So how do you draw it out? How do you make your business? How do you find that behavior? These are really the questions. So at the risk of delaying the Q&A any longer, thank you very much.
Great, Richard, thank you. Well, good news, we have a full hour to speak with our panel. I thought those were 4 provocative presentations, actually, so I'm sure that this group has got 1,000 questions. So let's use the mic if we can, so I'm not in the repeat business. And our first question here.
Okay. I had a question for John. I think incentives seem to be at the heart of a lot of the issues. So if you think across the industries that you audit, the operating cycles can be very long. So if you think of someone who's responsible for financial services where some of the transactions may take 10 years to pan out, what thought do you give to deferring that partner's share of the overall pie in a given year?
I will tell you that I probably spend more time on compensation issues and thinking about it than most other, because I do think I meant what I said before. It really is at the heart of getting it right. And I think it gets down to, I think the answer to your question, because it's not practical in a lot of senses when you do have very long tails to ultimately see the true result of somebody's activity today. That gets very impractical. What I try and get our people focused on are behaviors, right? Are we rewarding the right behaviors? And if we believe, as I do, that it's much to Rich's comments earlier, we are better off across any number of dimensions when we function in teams. My biggest fear in my role is the Lone Ranger, who probably thinks he or she is the smartest person in the room. And if we give them the ability to operate in a Lone Ranger type of environment, I think they pose tremendous risk, I think, to the organization, even if they may be the smartest person in the room. So, so the behavior I want to reward as I look at compensation is teaming. I want to reward behavior of people that bring other expertise from our firm to the table. And if you can identify the behavior that you think will lead ultimately to the right long-term result, then I don't need to know the result to try and correlate rewards to people's behaviors and outcomes today. Even if the outcome turned out to be not as favorable as we all thought it was going to be 6 years from now, if the behavior was consistent with the kind of firm I want to be and the way I want to operate, then I'm okay rewarding on that basis. So that's one perspective on it. It's a very complex issue, and we certainly do have some models where we can, and a number of companies that we work with have some models where I think they can, over a 2 to 3 year to 4 year period, defer some compensation in a way that does track a longer-term outcome of something. But I think when you get into much longer than 3 to 4 years, it's very difficult to do.
Bob Hertz?
Yeah, I guess this is also for John. So I understand that over in Europe, on the continent, the European Commission, and I think also in England, there's some folks that are kind of blaming the auditors, the auditing profession, for not having, shouted that these financial institutions were in bad shape, were very risky, and all of that. and I guess there's maybe a little bit of that going on here, but a lot less as I can observe. Wanted to get your thoughts on perspectives on that, and then kind of linked into that, from a risk management point of view, what kind of industry analysis you do in deciding how to, where the risks might be and whether or not how to manage them, or just stay clear of industries or particular segments of industries.
Well, thanks very much for that question, Bob. There is a lot of discussion, I think, for those of you following it, that's taking place, largely emanating out of the EU with the Green Paper and some other developments there. But I think we've seen this week, in fact, there was a hearing, Senate hearing Wednesday on the role of the auditor, largely trying to look at some of those same issues. So, I think if you're going to look back and try and assess blame, I think it's hard to come away with any other view than we got an awful lot of participants in the capital market system, and you know what? I think we all should have learned something, and if we didn't, shame on us coming out of the last cycle. And that includes the profession, in my view. But I think we run a real risk if we come at it in silos. And if we come at this issue in either the role of the rating agency, the role of the auditor, the role of the board, however, sometimes I think we get fixed on, we want to go after one issue, and this is a very interrelated and complex problem. I think it largely gets back to what information is available to who, when, and that information, I think you're going to miss the boat if you attack that issue in the context of a discussion of the role of the auditor. You're going to miss, I think, a big part of the game. I think if you want to attack the issue of, are we presenting the right information to investors and users of financial information on a timely and relevant kind of basis, and that's what we want to get at, then let's deal with it at that level and say what has to be different in the entire system, starting with standards, flowing all the way through to what's management's role in that to present. Do you want some independent attest function around some of that information? You may conclude some of it you need third-party attestation on, and some of it you don't. But first, let's get clear what information. I think back, Betsy, to some of Betsy's comments about what would be the most useful information. Start with that, and then migrate through to who's in the best position to provide it, how should it be provided, and there's absolutely a role for the auditor in that mix. And my personal view is we need to be, as a profession, very active participants in the dialogue that should be taking place right now. I'm personally not somebody who believes we should duck our head, hope this too shall pass. I think just the opposite. I think we should all assess what should have happened differently, what could have happened differently, and then go at it and try and solve it. My only advice is I think we need to go at it holistically, and we don't do ourselves much of a service if we try and go at it, well, let's focus on, was it IFRS or US GAAP that caused the problem? Was it weak boards that caused the problem? Was it auditors that caused the problem? Was it standard rating agencies that caused the problem? Maybe the answer is a little bit of everybody, and we need a holistic kind of response to it, would be my suggestion.
Trevor Harris.
So I actually had a related question, but it was going to be addressed to each of you in a slightly different context. So several of you mentioned the subprime so-called credit crisis. Some of us who believe in fundamentals would have said if you'd actually looked at who the people were, what their full borrowing was, and all the things that Rich sort of indirectly alluded to, we couldn't have all been that stupid. And we all, in some sense, understood it. So my question is, so to Betsy, you knew what was going on at some level in the banking world. What stopped you, not you, Betsy, but you as a group, both on the buy side and sell side, acting on it more vigorously? And to the extent that it is disclosure or not having enough information, what is your advice to all of us and the people on your panel about how to, I understand, John, what you said is exactly right. Everybody in some sense, and actually this is to Greg too, because he was wearing multiple hats in those things. We've got to learn. The question we all want is, what can we learn from it that we could change arguably tomorrow? We understand all the policy and political issues in dealing with this. And to Rich, for example, is you have clients or potential clients or people like you have these clients. How do you, and you say they made that error. So how do you defend that? Or how do you tell them, disclose that you're going to have this kind of risk so that they don't make the same mistake in the future? Or how do you compensate that auditor or not once you knew that the subprime wasn't going to be there? You consciously made an effort to stay away from them, according to what you said. But you also knew there were other clients that had it. So to Scott's question, did you compensate them differently? And again, I'm not trying to put blame. It's more a question to your point, John, is how do we take this and do something with it? And Tom, if you identify that, I agree with you. So give them the information. Show them who all these people are, if that's what Betsy wants or what John needs or what.
Who wants to be the first to reply to Professor
Well,
Perry?
I just want to say to John, I'll be happy to provide representation in answering.
Thank you, if I may call it.
Be very, very careful about answering that question.
Oh, gosh.
I'll take a quick crack at it while everybody's thinking deeper thoughts. See, I really think that the fundamental attributes. So don't forget, part of the train wreck that occurred was the securitization of a lot of the mortgages. It's not really a disclosure issue. I mean, this is in my view, because everybody knew what a subprime lender was. Everybody knew what a Alt-A borrower was. Everything defaulted in record numbers, even prime loans. And people took a great deal of comfort out of rating agency ratings. There were a lot of investors who, and also remember that there were no moms and pops directly investing in these because they weren't sold to them. Of course, the effect had lots of turnover for lots of people. But the people who were investing were largely people investing off of issues that really had nothing to do with the underlying credit, right? They had a AAA rating, so they were good to go. They had an insurance wrapper, so they were good to go. It was you could listen to people who will tell you that the bubble was caused by low 1% interest rates that just created the ability for people to borrow. So, I don't know that, let me toss this out. I don't know, Trevor, that it is actually something that you could fix or cure with a regulation or a tweak to an accounting standard or something like that. Bubbles don't really, I think, work that way. I think that you are driven by human nature. I think that people, whether it's a tulip or a home price, people are driven to excess by their very nature. And when you look at a lot of this behavior, I just am not sure that there's a regulation that you could have passed other than continuing to restrict the credit, not allowing that type of, person to buy a home, not creating different mortgage products that would have allowed it. A lot of people borrowed homes. They were qualified to the teaser rate and could not possibly pay for the adjusted rate. But did anyone not know that? Everyone knew that. It was clear on the face of every document that anybody produced. People just thought that they would be able to earn their way out of it or sell their way out of it because the house would keep going up. So that's a view. I wonder what other people think.
You want my answer?
Absolutely.
Well, part of what I'd say is a little bit of an echo of what Rich was saying is greed and fear. I mean, you're never going to get rid of greed and fear, and that's essentially what's driving it, right? But then your question is, well, can we reduce the distortion? This is what I'd say. I would ask the companies to answer the questions that we have for them. So that's pretty simple. Again, it's easier to ask than to give. But, just as an example, back in 2004, we were asking banks, how do you grow 40% in home equity second liens, right? I mean, you don't grow like 40% in second liens without a lot of risk. So that's part of what we were asking. Show us the tails. Well, we don't have to give that. The regulators don't require it. I would be the only one, blah, blah, blah. And so in all of this kind of post-burst discussion, one of the things that has come up, for example, that we've kind of pitched over to Treasury is, look, analysts have questions. Banks have to answer them. Why don't you just force them to answer the question? I know it sounds really basic, but if you were required to, that would have kept some institutions from going too far. It's not going to keep everybody, but maybe it would moderate the degree of, the amplification between bubble and bust, potentially. It gets back to the point I was making earlier about show us not only just what the quality of the book is on average, but, give us the tails. In the subprime piece, I think a lot of us were scratching our heads saying it doesn't make any sense. I mean, I sat down with a bunch of guys in 2005. I'm like, I heard that, CDOs are backed by subprime assets. They're like, yeah, 85% are. I'm like, well, how does that work? And to your point, they all ignore the loss content. They all ignored the housing price. And I think they took the housing price out of the model because it wasn't working, So, it's not like they forgot about it. And so, so then the investor community isn't necessarily aligned on this, right? Because there are investors who say, no, keep it the way it is. And then when I figure it out, like I said earlier, whoever gets the answer first and is right wins. So the investors don't actually want you to have the best information out there and the most transparent information out there. They want you to have something that looks okay, makes people happy, but, there's still enough loopholes that they can, maneuver their way around to make some money. Because in a perfectly efficient market, they're not going to make any money. So my short answer is answer the question.
Anyone else?
I think we've been thinking very much about what information set could be used to help inform. And I'm taking the perspective that this isn't a unique event. We've had banking failures every decade.
Yep.
Seriously.
I've been through 3 of them, yeah, I know.
Yeah.
So,
And with the internationalization, with the globalization of markets, it might be that the risks are even going to be spread even more comprehensively the next decade when this happens. And so at the board, one thing we can do is we can ask people what they'd like. But in some respects, many of the investors are not accounting experts. It's really up to us to try to figure out what would be the information, the best trade-off of cost, benefit, and form of information to help them make decisions. And so I think we're making a comprehensive effort to look at that in many, many dimensions throughout the whole model. That's why we're redoing all of financial instruments, not just impairment, not just classification measurement, the whole thing. And, one thing that we've recognized is I don't think anything on the face by itself is going to be the entire solution. that there is a need to understand the disaggregated risks within uncertainties and the risks within a company. And so we are, as part of this project, not only did we work to get credit risk disclosures more disaggregated in a way that be more effective, we are also looking at issues about when you do impairment. That one of the things that we ought to recognize that as boom cycles go on, often underwriting standards get more lax because there's a lot of money available. And so in the impairment model, should we require, in thinking about setting impairment amounts, that the bank be forced to think about underwriting standards, and when they become more lax, have to recognize losses related to those changes? Yes. So some of the things we're doing with that. But more importantly, if you think about the banking failures, you got short duration liabilities, long duration assets, and the ability for those liabilities to flee and very, very little equity and exposure to both interest rate and credit risk significantly enough that your assets can shrink and wipe out that equity in a nanosecond and cause the people that can flee to run. And the reason it becomes systemic is people flee, they run. The banks, there's a big worry about people leaving. That's why we don't know of any of the failed banks until after they're taken over, because they're worried about what's going to be, the regulators are worried about that. And so what we have to begin to think about is being able to recognize and provide insights holistically about the risks on the balance sheet, but then breakdown. And where we haven't done a good job is liquidity problems, and I'm not talking about instrument liquidity, I'm talking about the flee problem. Okay, what happens? How far, if you've got liquid assets, how many can you deliver to them before you're out of luck in the short term? And we haven't done a good job with duration matching and interest rate risk. And so part of this project is we're working very hard. We've added to the project doing additional disclosures in that area. And right now the staff's running around the world asking different people about ideas about how to do this effectively. Because one of the problems is it almost has to be a standardized measure to be able to compare and understand. If what you end up doing is just say, tell your story, you might want to hear in the 10Ks outside an MDA, tell your story. Tell me how you view risk and what you do with it, because that's important to understanding where the potential exposures might be. But we also have to get it standardized so that you can end up make evaluations of time series changes that make sense and cross-sectional differences. And we're trying to do that, but it's hard.
Well, it's hard, and I think it brings up the issue that risks change over time. So you might have a very robust set of requirements today that, 3 years down the road, you've moved somewhere else, and it might not even be 3 years, it might be 3 quarters. So I know that that's a challenge for managements, and I know that the SEC-related disclosures is such a high bar that, that's why you get a lot of this pushback from guys, because how they're going to be able to capture and show routinely over time with the same degree of certainty is obviously critical to their ability to present it. I mean, what am I saying? I'm saying the fact that you need to build your system to be robust enough to make sure that you can support the numbers that you present. I put it in the context SEC documentation relative to regulatory documentation, because I've asked banks a lot of times, why don't you just give us your regulator, because for the regulators, they'll give you loan disclosures. So what's the big deal? Just give us the loan disclosures that you give to the regulators. And the answer is, it's such a different bar. The bar for the public information is so much higher and more. I'm not saying it will never happen, but I can understand why, why the companies kind of push back a little bit, only because if we analysts are asking for lots of different information all the time and it's SEC disclosure, they're always going to be late, because it's going to be hard to put it together in a way that is, they're not nimble enough, as I guess, and I wonder if the whole system is nimble enough.
There's a whole school of thought that would say you already have plenty of laws. You got all the rules and regulations that you need. You are required under the current law to disclose all material facts and disclose everything that would affect your business in a positive and a negative way. And, at the end of the day, what more are you supposed to be doing? So is it the enforcement of those laws, compliance with those existing laws? Because if it's just fashioning a different matrix, believe me, there's a bunch of people in business school right now figuring out how to get around that matrix, just as there is everyone that's ever been built.
Well, you're bringing up the question, what is material?
Well, I would put
which is hard to define.
I would just have maybe a slight derivation of that, because I think Rich is onto something. And as you look back at what happened, everybody can have their own view of what could have done differently, woulda, shoulda, wish I'd had. But one of the things that I think as a profession we struggle with, as I look in hindsight, is how do you distinguish those, Rich, you talk about those material risks and uncertainties, and we're already required to disclose those. And I actually think companies do a pretty good job, and I think the audit profession does a pretty good job of focusing on and getting disclosure around individual company-specific events or risks that could affect that company.
I know that KPMG does an excellent job at that.
Thank you, Rich. The challenge, and I think we saw it in the financial crisis, is when you have a situation, let's say we had all had perfect crystal balls. What would we have all been disclosing in every set of financial statements we do for a financial services organization? We would have been disclosing things that are mega impacts that, if they occur, will affect almost every entity operating in that industry, and they would have come across as the most boilerplate, redundant, and lack of value-add kind of disclosure out there. We have a risk that we borrow short-term and invest long-term, right? Our assets are long-term assets, and we're dependent upon commercial paper refinancing to finance our operations. A lot of companies had those disclosures. Now, what we didn't have is an assessment of how near the risk was that the commercial papers market was going to totally seize up, and literally in the span of about 2 weeks, companies that had board meetings at the end of March and no problem, the third week of April were facing Chapter 11 or darn close to it because they had absolutely no liquidity. Now, let's say we had all had a perfect crystal ball, and as the auditor, we had walked into that board meeting and said, you know what, we think there's a real risk you won't be able to refinance that commercial paper, and if you can't, you won't be able to continue in existence, and therefore, you know what, we think we ought to slap a fourth paragraph in your accountant's report. And they would have said, you know what, if it happens to us, it's going to, that is not something directly related to us. That is that is a phenomenon that will seize up the entire capital market system. And what are you going to do? Put a fourth paragraph in every single set of financial statements out there? So I think I don't have an answer to this. I'm just posing. I think there's a challenge here to distinguish systemic, broad, industry-wide impacts that, if they occur, will affect a wide range of companies versus something that is a specific operational risk, to an organization.
Yeah, you see, I just think that in something like a massive national real estate decline, it's a little bit like walking into the ocean and saying stop. It's going to be hard. There's no one thing. So I think that's really it's an excellent point. There were certainly people that went the other way. Betsy, in 2005, there were people that bet that way, and it was a long bet to pay off. They had to hold on to that for longer than most people have the fortitude to do that. But a few people made a lot of money by going the other way. But it's not because they really ultimately knew facts that were different than other people. They just saw the consequences of those facts differently.
Okay, anything else on Trevor's question before we move? Question in the back. Yes,
Greg, one thing. When you talk about doing uncertainty disclosures or risk disclosures, what normally ends up happening is thinking about what the loss would be in normal markets with normal covariance and correlation. The problem is when a black swan event or something really big happens, those correlations go from being diversification effects negative to almost +1. And what we have to be thinking about is what drives that and how do you reflect that? Almost all the stress testing you see out there, so you have the standardized risk metrics, and then you stress test it for normal circumstances that could cause contagion or really bad problems. And the list of items that people stress test for are the black swans we know about. Well, those black swans are probably not going to happen again, and no one knows where it's going to be. And so it is an ultimate challenge to figure out if it's really about systemic risk, contagion, big effects. I don't know that anyone can predict that, but there is still insights that you ought to be able to show where there is stresses in portfolios at the entity level.
Or you could just deal with it entirely differently. We've got a strategic oil reserve because there's 10 million things that you can think of and 10 million you can't that might affect the price of or availability of oil. but you have a reserve against all of those consequences. So it may be that what you require, you just deal with it in a different way. And Tom will figure that out and get back to us. Hard to build a country that way, then.
Okay.
So I've got a question on too big to fail, which I guess I could ask Betsy to respond to, and perhaps John, if you'd care to respond to it. Too big to fail is a response to systemic risk, and the consequences for this too big to fail on moral hazard within banks, auditing firms, etc.
So
I didn't catch.
what was the question?
So the question is, what are your views on too big to fail as a response to systemic risk within our economy?
What's
And
my
he directed that to you.
Oh, I know. Wait. What's my view of too big to fail?
Yeah. So there's an argument in the popular press right now, and lots of people hold to it, that banks are simply too big. And one can make the argument that too big is a response to systemic risk, because the government are going to bail banks out if they are faced with these 3 sigma or
Right.
events that are more extreme than that. So in your view, could you offer some insights as to whether we think that some of our professional services firms and financial services firms are too big?
Right.
Should we be, what I'm just curious about what your view is.
Just general on the too big to fail debate. Where do I stand?
Precisely.
I'm so working for the top 5. I'm not sure.
You're too big to fail.
I'm gonna be viewed as being 100% no. What I will say, so I obviously as a bank analyst think about this all the time, and I think about it from a theoretical perspective as well as a practical perspective. On the theoretical perspective, are institutions too big to fail? I.e., do we need the government support to be there to help them out? I don't think it's a big, small thing. I think if we were a nation of, thousands more banks all the same size, you'd have the same question that's coming up. I mean, obviously, you can look back in 1929, and you would argue that institutions that represented a much smaller percentage of the GDP were too big to fail. I think one kind of interesting consequence of the cleanup from the bubble bursting is that concentration risk has increased more. So it gets back to something someone earlier said, that let's think holistically about this. Well, you are actually concentrating more and more assets within a smaller number of institutions, and QRM proposals the other day would push that even more aggressively, because you're essentially taking away securitization market from some big asset classes and saying it's just going to be on balance sheet, which to the earlier point, maybe that's okay. Well, it's okay as long as you're okay with a much smaller economy. I also think about too big to fail as it relates to the companies that we're servicing. In my opinion, part of the reason why we have institutions that are as large as they are is a reflection of globalization, is a reflection of multinationals. I mean, you can look at any number of large organizations, and John and Richard are going to be much closer to this than me, but you look at large global media, telecom, oil, pharma. These companies need financial support, and they want to be somewhat efficient about it. If you're saying, well, too big to fail, let's carve them all up into, each of the big 3 into, units of 10, you are now making it a lot less efficient for those companies. Does that matter? well, maybe you should at least have a view on that before you do it. Will the rest of the world go down the same path? Too big to fail in the U.S., you've got the same kind of construct, even a greater degree of concentration in Europe and obviously places like Japan. So you'd have to have a global solution. So taken to its nth degree, if we carve all these institutions up and make them smaller, do you end up getting rid of FDIC insurance because no one needs it anymore? I don't think so. So I think you just have a smaller definition of too big to fail. And ultimately, I think it's not the size that really is the issue. It's more the management. Do you understand your risks? Do you understand the uncertainties? Are you watching it daily? Are you protecting yourself? I mean, that more than size, I think that drives who wins and loses, and who's able to, perform their function in the economy.
Okay, anything else on too big to fail from the
I've got
panel?
lots, but I'll stop there.
Okay, Christian.
Yeah, so I have a question that originally was for Tom and John, but it relates to something that Rich said in response to Trevor's question. So, Tom, you started by saying that a lot of the uncertainty gets actually dealt with through disclosure rather than recognition, and we're careful about sort of what we recognize. And just to make this a little bit more concrete, let's take loan impairments, right? So loan impairments going to the crisis, banks were relatively slow in their impairments, and part of the response was that, well, that's because we have certain rules that limits what we can recognize, but the rules also allow and call for disclosures even when you cannot recognize, and as Rich said, there is the 8K requirement that would, in principle, just catch anything that is sort of material to your business. Now, the interesting thing is we didn't see these disclosures. And so one thing that I find interesting, sort of about your remarks is that we talk a lot about the rules and, sort of additional rules we need to put in and how we need to change the rules. In my mind, there's way too little discussion about enforcement. And to give you another example, which ties in what I think was the discussion after Trevor's question, is I think we also need less static rules. The rules are sort of, static, and as John pointed out, a lot of the disclosures that would have been provided would have been boilerplate. What we kind of need is when we get in trouble, if there's somebody to step up and say, now we need more of this. Now, I've thought about this problem. One of the issues with this is going to be, again, implementation and enforcement, and in particular, in that case, political resistance. If the SEC or anybody, the Fed or anybody would have stood up in the middle of this party when everybody was still dancing and would have said, we want more disclosure now, the banks and everybody would have argued that the world comes to an end and we're ruining this wonderful party if there's going to be this type of disclosure. So I think, in my mind, what we need to think a little bit more about is sort of what are reasonable enforcements, and we don't want to go the extreme, right? But I guess to me, it's the implementation and enforcement where we need to have the discussion, less so over, changing the rules.
Tom?
I agree with you, with your perspective completely, in many respects. I think we've built a disclosure model that is almost a disaster at this point, because there, after the fact considerations, after we finish doing standard setting, that we just sort of slap together some ideas as to what might be good disclosures. And they end up tending to be voluminous requirements that become checklists that you lose the wheat to the chaff. There's just too much. And so one good thing that we're doing at this point is a disclosure framework project. We're really starting to try to figure out how can we take a common view that ends up providing a more flexible disclosure regime that sets disclosure objectives around certain key things and give the entity the requirement and the responsibility to be meeting the objectives to report what's important and what's not, and ignore what's not. The problem in the disclosure regime partly is how do you define materiality for disclosures? You can look at the auditors. That's really, really hard because some of that disclosure is not just quantitative, it's qualitative. And we end up getting, in our system, lawyers in the game that will just write forever on meeting the requirements, but not revealing much information. It is a huge, challenging issue. And one area I think that, many of you may know that we've been trying to redo loss contingencies in the disclosures, because we've been told that what you end up finding out about the loss contingency is the day after the check's been written. And there's not enough good information. And at first we tried twice to go out there to be more prescriptive about what you must say. But what we were trying to do there is, in the prescriptions, talk about a living document or a model that says when you've got a loss contingency, as things progress, the disclosures ought to change, and you got responsibilities around those changes. But before we even went to the point of doing that, we asked the question, well, is the problem that we didn't write good disclosure rules, or is it the fact that there's problems in agreement between the American Bar Association and the auditors, and the SEC is not even enforcing what's happening in Statement 5? And so we said, time out, let's stop writing and go forward and ask the SEC to try to enforce what's going on in Statement 5 and see if that gets us there better, rather than writing up a big new prescriptive list of disclosures, even with some flexibility in them. So I think the perspective I agree with. The challenge is to how to do that well, and how to build into a system, if you set up disclosure objectives, and then the requirement that you ought to be morphing your disclosures to meet those objectives, whether or not we will ever get to an auditing in an enforcement environment that will result in quality the way you want. But it is auditing and enforcement as much as it is what we write.
This, I guess, is addressed to John, and it could have gone to Steve Gursky this morning, but being the person up there right now who's sort of ahead of a big organization, what do you find in dealing with multinational operations and multi-jurisdictions and everything else? What are the challenges that the differing levels of risk, the views of risk, or even just thoughts about what risk is, plays that you're trying to deal with in governing that kind of an organization, since that this is a session on coping with, sort of the coping that has to go along with that?
Well, that's a great question, and I think it goes to what I touched on briefly maybe in my opening remarks. I think as difficult as it is in just thinking about it in the context of a U.S. firm of 22,000 people, where culturally they were pretty homogeneous. And then you migrate to an environment where there are very different cultural norms in various parts of the world. And I think what I come to learn is the immediate response. At one point in my past, I was actually in charge of global risk for the network, right? And thought, well, this will be really easy, because I can write some really good policies that as soon as I get them down in the manual and send it out, we'll be in good shape. And the reality is you can't operate that way. You have to take into account what you're starting with in terms of the cultural norms and the way business is done in various parts of the world, and then build from there as to how do I get back to something that looks like a consistent culture around how we want to evaluate and manage risk. But if you just try and do it from a Western U.S. standpoint, here's the rules, let's impose it, they'll get ignored and you'll have made no progress, even though you'll have a really nice looking manual on everybody's shelves. So I think you have to be sensitive. It takes an awful lot of on the ground, pick and shovel, and it is not directed from the top. It has got to be built up in 140 countries around the world, where you set out some guiding principles about what it is we're trying to achieve. Now, how can we do that in the context of the environment you're operating in, and at the end come up with something that we think is pretty darn comparable? The only other complication I will say is there are certain matters in which there can be no compromise or deviation. So you've got a set of things out there which you have to say, I don't care what the different norms or cultures may be. We will not be flexible on this. It is what it is, and that's just the way it has to be. But there are a wide range of other things, I think, where you can get better compliance and ultimately more consistent behavior by recognizing that you have to take into account some of the cultural norms that exist in different parts of the world.
Anybody else on that question from the panel? Patty Fairfield.
I actually have a comment, but I'll try to disguise it as a question. I was looking through Citibank's 10K the other day, and there was a section in there on new accounting standards, and it was several pages long. This is just an extreme example of a feature of financial reporting system, which is that the standards are always changing. These changes range from trivial, like grossing up the minority interest and renaming it non-controlling interest, or adding some new blah, blah, blah about vendor-specific objective evidence, to much more extreme changes like the new lease standard or changing the consolidation standards. Every time one of these changes is introduced, a user of financial statements first has to figure out what the standard means, then figure out when the firm has adopted it, what the adoption means to its standards, whether or not it's actually changed its behavior, not simply its reporting, in response to the standard. So there's tremendous instability in our accounting model. So my question is this: with the best of intentions, do you think the FASB has done more to contribute to risk and uncertainty in the financial reporting system than to resolve it?
That's for Betsy? I thought that was for Tom. This question for me?
Actually, it's for Tom.
Yeah, see?
That's what we all thought.
Yeah. I think both. I do believe that when you do substantive changes like you're talking about, that it does rock the apple cart significantly. We are thinking, that we have this memorandum of understanding with the IASB, and we're really doing some big stuff with the accounting model right now. And we went out for public comment to preparers and users to ask them how should we best do transition on this. And one of the things that I heard that I'm most attracted to is almost all the conversation is about the difficulty of preparers transitioning. And what I'm most concerned about is users transitioning. And there is SAB 74 disclosures that end up saying that you've got to talk about, if you know that there's a future accounting change, that you've got to talk about the accounting change and try to quantify it. Though I don't think those disclosures have been as good as they should have been. And so one of the things that we're contemplating in this discussion is mandating more, like Christian was talking about, a living set of disclosures, a morphing set of disclosures that the users can have. As what we're talking about is, because there's such big changes, that we delay the effective date so that companies could run parallel systems under the old model and the new model for year -2, year -1 and 1, so they're going forward and building up the comparative information, but then turning around and requiring that there be disclosures in year -2 for the investor as the company's doing that about what might be the directional effect of what those changes are going to be, and then move into year -1 and try to get them to be saying, now that you've got a little bit more experience, not only directionally, but start giving us ballpark of the quantitative effect. And then moving into the change period where they lock in and there's some growth and learning in the system, so there's not as much upset in the investor community when 3 years of new data is dumped on it. And that's trying to be responsive to the issue that you raised, but of course every time that we introduce new standards, we hurt comparability and consistency. That's one of the reasons why in the new Chapter 1 of the conceptual framework, comparability is an enhancing characteristic, not an absolutely necessary characteristic, because we recognize we cause problems. And it's our responsibility to make sure that when we go forward, most of the times we're making a significant positive improvement. And I would assert that sometimes we don't.
Okay, anyone else on that question? Okay, let's go on this side of the room.
The topic of the panel is coping with uncertainty and risk. It's kind of a very broad topic, and my question is kind of going to be very broad, addressed to everyone. We could easily be having this discussion like 8-9 years ago and talking about accounting scandals, or 12 years ago and talking about the internet boom and bust. The point I want to make is we seem to be constantly learning a lot of lessons, but they seem to be very localized. And we're not learning lessons from the lessons already learned. So why is it that, I mean, we're talking about this particular bubble right now, which just, burst a few years ago. Maybe 3-4 years later, we'll be talking about the next bubble. But, from a perspective of like risk management, auditing, use of financial information, prepare of financial information, why is it that, why are we sort of having these discussions like apparently with increasing frequency? It's just the same basic sort of, thing going on in a different setting each time.
Because you really can't manage risk out of human beings. People are going to take risks. Some people are going to think they're worthwhile. Some people will think they won't. But, you can read a great book like Extraordinary Popular Delusions and the Madness of Crowds, and you can see that from the history of time, you are going to find people who will engage in excessive behavior that's only recognized in hindsight. Because nobody wants to miss the gravy train, and so whatever that happens to be, people are jumping aboard with enthusiasm. I just continue to believe, and I think history would bear it out, that you can try as much as you like to come up with rules and regulations, and they're very important. But fraudulent behavior, bubbles, aside from using words to say you shouldn't do it, people are still going to do it. And if enough of them do it after a period of time, you wind up in these periodic issues that we have. I personally just don't think it's much more complex than that.
I actually believe the academics have a role in this. That we ought to be teaching not just financial reporting, but boom and bust cycles and what's happened at the end of every boom cycle, major boom cycle since the stock market crash of '29 has resulted in a series of accounting scandals at the end of that boom cycle. Why don't we know that? Why don't we have the healthy skepticism to say extended boom cycles we ought to audit better? Why don't we talk about that? Why don't we bring the history of the interaction between our accounting, our reporting, and economic cycles?
Okay.
Thanks. I'd just like to ask a question which often is the elephant in the room in discussions such as these, and that is, does the panel think that the idea of one-size-fits-all general-purpose financial statements has actually had its day, and that we should be looking at a completely different form of financial reporting? Certainly my experience, again in Europe, is that increasingly boards are seeing their financial statements as an exercise in regulatory compliance, not an exercise in market communication, because the means by which they communicate to the market are so different to the financial statements. Their numbers, internal reporting numbers on which they manage their business, are getting more and more divorced from their GAAP numbers. And as I say, they're non-GAAP measures which are increasingly being reported to the market and so on. So we see this widening of the gap between internal and external reporting, and we're seeing increasingly different, more emphasis on other forms of communication with the market outside financial reporting. So is it the case that general purpose, one size fits all general purpose financial statements have had their day, and that we really should seriously be looking at what other means there are, and also what other areas of assurance the auditors should be providing, not just on the audited financial statements. The issue of disclosures, I mean, disclosure actually have been out of control for years and years, both in terms of the volume, where I don't believe that users actually can see the wood for the trees and cannot distinguish between what the important disclosures are and what aren't the important disclosures, and also what's required. There are areas where we give pages and pages of disclosures which actually are not necessarily particularly relevant. And the last point I'd just like to make, if we do go down a more principles-based disclosure regime, which is my understanding of what Tom's talking about, then there has to be competent enforcement of that, because if we move away from rules-based disclosures to principles-based. If there's not serious enforcement around that, we're going to be in a much worse position than we are currently.
Anyone on the panel like to react to the observations?
Sure. I'll start maybe. I do think that's a real issue. It's certainly an issue that the CEOs that I'm dealing with on a regular basis are very concerned about. In fact, they really, I think, in many measures, focus less on individual standards or where we're headed as much as just their view that the financial statements right now aren't as relevant a tool in helping them communicate to the users of their financial information what's really going on in the business. And I think you see a growing, I think part of the response to that, which I think has been positive, is the the growing acceptability of some non-GAAP disclosures in financial reporting, which allows companies, I think, to try and make sure they are translating their GAAP financial statements into the in a way that will be most useful for their investors. And again, I think you can look at that from two vantage points in terms of whether companies are well-intentioned or not. And but if you start from a standpoint of companies to a large extent are trying to get the relevant information in the hands of investors, then I think the expanded use of those non-GAAP disclosures, I think, are an indication of the divergence that you're talking about occurring. So it is a challenge. I think all the standard setters, I think, understand that and are focused on it. I don't think if I read into your comments in terms of one size fits all, does that mean we should go to different sets of standards for different size organizations and things like that? Personally, I have a lot of misgivings about that. And that's a whole nother debate maybe in terms of should there be a GAAP light for different kinds of organizations, which I would not be thrilled about. But I think in general, the observation you make, I think, is a challenge we all need to keep in mind as we collectively work to try and make sure we have standards that are providing useful information, which I think Tom has alluded to on numerous occasions today, the outreach to users to try and, as the FASB is developing standards, try and get that input. We need to continue down that path because there is clearly a sense in the companies I'm dealing with today that there's a fairly big disconnect in terms of what they have embedded in their financials and what they believe the most relevant way to communicate that to their users are.
I'll accept your comment in one way, agree, and disagree in another. I think behind the comment, I could interpret that as saying the financial statement should be the complete information set for companies. And I don't believe that can be the case or should be the case, especially with the increasing information environment that we're in. So I think we have to think about financial statements in the context of that full information environment and decide that which audited financial statements, what benefits they can provide relative to other outcomes. And I think that we ought not to try to make it all encompassing. I think management should be able to tell their story in different ways outside the financial statements and maybe not subject to audit. But I do think that the proliferation of non-GAAP measures, which are primarily adjustments to income, suggests that our income statement is greatly in need of restructuring. And that I will agree we should look at very carefully. Investors often try to segregate their operating decisions from their investing and financing. Why aren't we sorting that in the income statement? We have much complexity now in business, and we have some sorts of changes in assets or liabilities that persist, and others that are only one-time dollar effects. We ought to be segregating those and sorting out those items carefully for investors, because many of the things they're reversing are these one-time things. My worry is when management does that, all they're doing is reversing out the negative things, but the positive one-time effects they're leaving in. and we have to worry about some of those things. But I think the income statement needs great restructuring, and maybe that would deal with the problem.
Anything else on that question? Kathy Schrand.
Question for Richard. I would assume that one of the big risks that someone like John thinks about is actually litigation risk. And so do you have any thoughts on how well our legal system does at thinking about risk in the way that he was thinking about it, that it's impossible to eliminate, you can only mitigate it, and so some of the time bad outcomes are just going to happen. And is the system good at differentiating when a firm was prudent in its risk management but just realized one of the bad outcomes versus when they weren't so prudent? Are they good at looking at the evidence of risk management and determining substance over form in risk management practices?
You know, it's really an excellent question, and it's one that the law makes exactly the kinds of distinction that you're talking about. There are different penalties for negligence versus recklessness versus wanton behavior. Fraud carries with it a scienter requirement. Scienter means, you know, a knowing intention to do something wrong. So I think there's, you know, very deep-rooted in our legal system the concept that we treat inadvertent wrongs different from calculated wrongs, different from accidents. You know, there are certain things where there's strict liability, where we say engaging in that behavior is inherently so risky that no matter why it goes wrong, you are liable to anybody harmed. On the other side, you've got a balance, if you will, of equities in terms of figuring out where to apportion and assign blame. So I think the structure of the legal system, you know, is very much attuned to that. Even the financial disclosure laws, you know, the Section 11, which some of you may know about, is a strict liability provision, where Section 10B, which is the anti-fraud section, carries with it, you know, that scienter requirement. So that's a pretty well-conceived issue. The question of determining exactly whether a person's behavior falls into which of those categories is really the trick.
So we have a number of more questions. Unfortunately, we are out of time. And a couple of panel members have to hustle away as well. Please join me in thanking these folks for a wonderful discussion.